Howdy, friends. Maybe you've heard the ads that talk about guaranteed returns of 5% or 6%, or I think the other day, maybe I even heard an 8%er. Pretty impressive numbers. We're going to tell you why those are the very definition of fake ads on the program today, along with give the millennials that are listening to the program out there, most of them probably are listening to our podcast rather than our radio program, as the demographics suggest. We're going to give them a bit of a wake-up call on the program with some of the statistics that we're going to share with them. Sadly, they are not doing nearly as well financially as their peers. All that and, of course, much, much more here on today's program. This is Dollars and Cents, and my name is Joel Garris of Nelson Financial Planning, and you're listening to News Radio WFLA Orlando. But before we get started with all of that, we actually got a grab bag of statistics that we wanted to kind of share with you because we thought some of these were kind of interesting, and they kind of tie in with some of the topics that we've covered in past weeks on the program. So here goes. Ready? As you all know, unless you've been living under a rock, this is the third year of a presidential election cycle. And one of the things that we said at the beginning of the year, when we made our fearless forecast, as we typically do each and every year for the past 30 odd years on the first January 1st program, or the program that is just before January 1st, the fearless forecast, one of the things that we said was, well, this is a third year of a presidential cycle, which traditionally has been the strongest. Now, obviously, we got a few weeks left in the year, that's for sure, so things can often go sideways, but the reality is, so far this year, the overall markets are up over 20%. So that's a pretty good number. You'd really need a calamity between now and the end of the year to kind of reverse that, which means then that, once again, this year, the third year of a presidential election cycle, the markets have had a positive year. This, in fact, is the 20th, assuming the markets close positive for the year. They're up about 20% so far this year, so seems to be on track for that. This would then be the 20th consecutive third year of a presidential term that generated a positive return for the stock market. So some pretty interesting stuff there. Why do you suppose that happens? Well, the reality is that the executive branch can, in fact, do things to help stimulate the economy, whether that's through deregulation or whether that's through encouraging spending or through tax cuts or the like. And they concentrate most on that, as you might well imagine, when the memory of that is going to be freshest in voters' minds, which is why that third year is usually a pretty good year. And certainly so far, the trend for this year appears to be that way. One of the things that we have been talking about is, of course, the China trade deal. And so now if we take a look forward to next year being the fourth year, being the election year, there's some interesting statistics on that may very well, in a few weeks, serve to be the basis of our fearless forecast for the year 2020. If we look ahead to next year, since 1928, the S&P 500, so the broad-based market, 500 largest companies, those are the ones that, in America, those are the ones that make up the S&P 500. In election years when the sitting president is running for re-election, doesn't matter whether he wins or loses, but sitting president running for re-election, on average, markets are up nearly 13%. In years where you do not have an incumbent seeking re-election, the market performance is only up about 4.5%. So some interesting numbers as we sort of cheat and look ahead to next year in terms of market performance, particularly overlaid onto the presidential term, the presidential election cycle. So some interesting numbers there that we saw this past week that we wanted to share with you. In other news, the other interesting number we saw was the latest out of our good friends in Greece. Now, you remember a few years back that it seemed like Greece was making all of the headlines and generating a lot of response in the markets as a result of that. And one of their problems, just to recap, is that they basically were bankrupt. I mean, they had offered pensions at such a high level to citizens at such a young age that it was just completely cratering the economics and the balance sheet of the country of Greece. As recently as 2012, they were not able to borrow any money from anybody. Remember that? That was the backdrop. What's fascinating is just how low interest rates are worldwide. And when we look at interest rates here in this country, we talk about them being low and historically low. But on a comparative basis, they are, in fact, quite high, particularly when I give you these numbers. Greece, right? 7 years ago, not able to borrow any debt on the world markets because it was basically bankrupt. It was like a train going off the tracks, jumping off a cliff. Nobody was going to let it loan it any money. Fast forward to 2019. And the 10-year debt of Greece today costs the Greek government 1.44%. So just to give you some perspective, I am the country of Greece. I can borrow money from the world market and agree to pay them back over a 10-year period of time, much like any loan, because that's, after all, what debt is. It's a loan. A bond is a loan. It's debt. So I borrow money from you, and then I agree to pay you an interest. Right. That's your profit on it. The interest rate that Greece now pays on its 10-year debt is 1.44%. You heard that right. 1.44%. To put that into perspective, the yield on the 10-year Treasury, again, same type of debt instrument. It's a 10-year loan. I'm loaning money to the U.S. government, or maybe I'm loaning money to the Greek government, and I'm going to get that money back, plus my interest rate. U.S. government, interest rate, 1.83. So somewhere along the line, the numbers have gotten terribly skewed, which is really part of this issue that we've been talking about on the radio program in past weeks and months, is that you have so much debt that is sitting at so low of interest rates that it virtually is not costing any of these governments any money to issue out the debt. And there's no clearer case of that than the fact that Greece can borrow at 1.44%, but the US of A can borrow at 1.83. Just staggering when you stop and think about it, because the reality is our economy and our country and our demographics are a multitude better than what still exists in Greece. Greece's problems didn't all of a sudden magically solve themselves within a 7-year period of time. But it's fascinating when you hear just how low those interest rates are. Pretty dramatic stuff. When we get back, we're going to tackle those ads that you hear on the radio and on the internet, and we're going to debunk it. It's going to tie into this interest rate conversation pretty quick. So stay tuned for that after these messages here on Dollars and Cents with your host, Joel Garris of Nelson Financial Planning on News Radio, WFLA, Orlando.
Of your dollars.
Welcome back, ladies and gentlemen, to the program Dollars and Cents. This is your host, Joel Garris of Nelson Financial Planning. Have you heard the ads? They're all over. It's hard to miss them. They're on radio, they're on internet, they're all over the place. And they talk about these high interest rates or rates of return that you can achieve and that they are guaranteed that you're going to make 5% or 6% or 7% or 8%, and you're never going to lose any money if the market goes down. They're all over, so I'm sure you've heard them. Well, this segment of the program, we're going to talk about what those ads are referencing, and we're going to do a little debunking of exactly what those numbers are. And at the end of the day, the conclusion is that those ads are fake ads. The very definition of fake ads. So let's start. First of all, what is it that they're ultimately advertising? What's the product in play? The product in play is an annuity. And what an annuity is basically it's a contract. It's a document, a contract that you sign as one party, and the other party to the contract is the insurance company. Because an annuity is going to be issued out by an insurance company. So we've got two parties to the contract. You, the investor, and the insurance company. You agree to give your money to the insurance company per the terms of the annuity contract, and then they agree to various guarantees and payments of streams of income. Now, when they have that money, what do you suppose they're doing with it? Well, they're taking that and doing their own investing. Well, here's the interesting thing about how insurance companies invest. And this comes to us through the National Association of Insurance Commissioners. If you look at how insurance companies in America invest those dollars, 72% of the investment portfolio of insurance companies is in fact invested in bonds. Now, at the end of the day, that really shouldn't surprise you that much because, after all, the insurance company is going to take a very conservative approach on it. I mean, that's how insurance companies operate, right? They've got a pool of assets and they have liabilities that they're going to have to pay out from that. Their requirements under the annuity contract. And so consequently, they've got to make sure that they can make those payouts. Otherwise, how good is the contract that you signed with them in the first place? So as it is, insurance companies as a whole are going to be much more conservative on how that money gets invested. And certainly the statistics reveal that if you look at the investment allocation of the assets of an insurance company, 72% of the portfolio is invested on the bond side. Only about 2% is actually invested in the stock market. The rest of it is hedges and things and options and things like that. Okay? So you've got the asset allocation. It's 72% bonds, 2% stocks, and the rest of it is basically some structured stuff that works like futures contracts, options contracts, things like that to kind of hedge the numbers. So let's think about this for just a second. The insurance company is not entering into the annuity contract without making profit. I mean, I think we all can agree that insurance companies are some of the most profitable businesses out there. And insurance companies certainly make a pretty good profit. So that profit has somehow got to come out of the performance of the assets that the insurance company holds. And with only 2% in stocks and 72% in bonds, let's come back to the prior conversation, which is very simply, okay, how much or what's the current yield on bonds today? Well under 2%. The reality is, when you stop and think about how that money is invested and what those ads are talking about in terms of rates of return, it's completely fake. Because there's no way with that kind of an investment allocation that the insurance company is getting the kinds of return numbers that are advertised in those radio and internet ads. So where does it come from? Well, It comes from a little bit of a manipulation of the numbers. By including the return of your original investment into the percentage return, that's how they get to that number. So let's give an example. Let's say you gave them $100,000 and they agreed to pay you $8,000 a year for the next 20 years. The advertisement on that would say, we're going to give you 8% return, and it's guaranteed, and it's not going to fluctuate. Okay? But here's the fine print. It's good for 20 years. Okay, now wait a minute. Some simple math. If I get $8,000 a year for the next 20 years, I got $160,000. But my original investment was $100,000. And this is where it's voodoo economics, to borrow the old expression back in the Reagan days. But it's the very definition of voodoo economics. I guess today we would say it's the very definition of fake news. If you include the amount of money that you gave somebody as part of your return, that's not an accurate reflection of what your return is. If I give you $100,000 and you give me back $8,000 a year for the next 20 years, that's not an 8% return. You gave me $160,000 over that 20-year period of time. I gave you 100. How much profit did I make? 160 minus 100. I only made $60,000. Over a 20-year period of time, that means I made about $3,000 a year. Divide that number back into the 100,000, and you get your rate of return. 2%, 3%, somewhere more in line with what's reasonable. It is always surprising when people are willing to suspend basic math, basic knowledge, to believe something that just is not possible. You've got insurance companies where 72% of their invested assets are sitting in bonds. Bonds are making less than 2%. U.S. Treasuries under 2%. But yet, many people suspend that belief and think that they're going to make a return that sounds much higher. And the reality is that it's 100% fake in terms of the calculation that's being done to come up with that rate of return. So don't believe the hype. It's voodoo economics. It's fake news. Whatever generation you're from, it's got an expression, and nothing is more appropriate to label those ads as such. Nobody's getting a 5% guaranteed return, a 6%, a 7%, a 8% guaranteed return. They're simply including the money that you gave them into those numbers, and that's the fake part of the advertisement. It's not possible, right? Investment portfolios of insurance companies are 72% sitting in bonds. Not possible. Not possible for them to generate their return and also make their profit and guarantee you the kinds of numbers. So don't willingly suspend your basic common sense on a hope that somehow something is different than what it should be. I assure you it's not, and the calculations are fake. That's our take on all those ads that you hear. When we get back, we'll continue the conversation. We'll shift some gears. We'll talk about how millennials need to kind of wake up and smell the Starbucks, if you will, when we get back here on the program. This is Dollars and Cents with your host, Joel Garris of Nelson Financial Planning on News Radio WFLA. Welcome back to the program, ladies and gentlemen. Dollars and Cents here on News Radio WFLA Orlando. My name is Joel Garris of Nelson Financial Planning. This segment of the program, we thought we would kind of wake up the millennials a little bit, to have them smell the coffee, because the latest statistics are not particularly good as to how their age group is doing. To recap, you are a millennial if you were born between 1981 and 1996. That means you're somewhere between 23 and 38 years of age. The reason you're important is you're basically responsible for funding the Social Security of the baby boom generation. So they're particularly concerned about making sure that you can do a good job and you work and you pay your taxes and you pay along the way, because you're responsible for funding their retirement. Sorry, but that's just how it goes. The reality is, though, that unfortunately, that age group is way, way, way behind where it should be on a historical basis in terms of their finances. This statistic comes from the Federal Reserve Bank. Okay, so it's not, just some institution that nobody's ever heard of or doesn't really have enough resources or any of that. This is the statistic from the Federal Reserve Bank. Federal Reserve Bank says that the average millennial in 2019 had a net worth that was 41% less, obviously on an inflation-adjusted basis. There's an inflation adjustment in there. Net worth 41% less than the net worth of a similarly aged adult 30 years earlier. Let me say that again. According to the Federal Reserve Bank, the average millennial has a net worth that is 41% less on an inflation-adjusted basis than similar adults from 30 years ago. What's happening there? Well, we've got a few theories, and we're going to talk a little bit about it here in this segment. And what, if you're a millennial, what you need to do to get back on track. And there's been a lot of studies and a lot of statistics out about that particular generation, that some of which, if you kind of parse it through and sort of connect the dots a little bit, it helps to explain why they might be as behind as they are. I think one of the first things is that society is very different today than it was 30 years ago. And not to cast too much judgment, and I don't want to cast too much judgment on millennials as a whole. I think this is a society issue as a whole, not just unique to millennials. But in today's world, you have a much more of a need it now mentality. It's just so easy to click a button and buy something. You walk into stores, people are just, kind of flicking their phones, okay? Giving a credit card, whatever the case may be. It's just too easy. And what that does is it leads to a habit of spending what you're bringing in. And if you're spending what you're bringing in, then you're never going to be able to save anything. You're never going to be able to get ahead. You're never going to be able to buy that first house. You're never going to be able to do so many different things that come from that. So first and foremost, it really is about trying to track how you're spending your money. It's so easy to spend money in today's world on anything under the sun. There's websites like Amazon, you click and poof, it shows up at your door. How easy is that? How easy can that be? That ease of use, we believe, leads to a culture that spends more than it really should, a culture that spends too much. And so one of the pieces of advice that we would have for you, and particularly for those millennials, that millennial generation that is behind its peer group, substantially behind its peer group, is to start carrying cash. Cash, yes, cash. I know there are some places that don't take cash anymore, okay? But carry cash. Because you will see visually in your wallet the cash going out the door. And when you've got less cash in your wallet, you'll stop and think twice about spending that money. So our first piece of advice on this is start to carry cash. Give yourself a certain amount of money that you're going to spend each and every week. Put that cash in your wallet. And when the cash is gone, you ain't spending anything more. That's the best way to track it. It's just far too easy to click, swipe, tap, whatever, Venmo, whatever the case may be, and you lose track of it. Go to cash, and you'll be able to keep track of it much better and much easier because you'll see the cash in your wallet start to go down, and maybe you'll start to spend less because you've got to get caught up. The statistics from the Federal Reserve Bank are shocking. 41% behind where similar aged adults were 30 years ago. Another one, don't be intimidated by the stock market. We've seen the statistics on this, and millennials as a whole have a tendency to be much more conservative on their investment allocation than they should be for people that are basically in their 20s and 30s. Don't be intimidated by investing your money. And don't be distracted either, because there's a whole lot of distractions. Bitcoin, okay, gold, whatever the case may be. There's all kinds of distractions from an investment perspective that will cause you to lose track, to lose ground. So be an investor, be an owner of the companies that make the stuff that you and I and the rest of the world uses every single day. Be an owner. The asset allocation for most millennials is much more conservative than it should be. In your retirement account, if you're in your 20s and 30s, you should have virtually nothing on the bond side at this stage in the game. You've got another 20 to 40 years to go before you even can get access to that money at 59.5 without even without a 10% penalty. So you've got to look at your investment allocation and to try and make up that ground. And don't be afraid to start. Far too often, particularly if I can just swipe, tap, or whatever, and get something, I'm going to give in to that urge. Remember, investing is about time in, not timing. Start small and build from there. But it's important that you start. Far too often, it's easier to say, I'm not going to bother, or I'll do it next year, or whatever the case may be. But you've got to start saving for your retirement, for your future, for a potential home purchase, all of those kinds of things. And you don't have to have $10,000 to do it. A lot of savings programs can be set up for $50 a month, for $100 a month, for very low numbers. And so that's the important thing to remember. Your employer plan also those contributions come directly out of your paycheck. It's easy. You can set those up at very small increments that come out of your paycheck on a regular basis. So remember, folks, look, if you're a millennial, you are way behind. That statistic, when I first saw it, was pretty shocking. But it has to do with society today and how you overcome that. Our recommendation is to carry cash. That way you keep track of exactly how much you spend. Don't be intimidated by the stock market. You've got to have investments that are going to grow because you've got a long time in front of you. And you don't have to start with the $1,000 or $10,000 or any of that. Start small and build from there. But most importantly, you got to get started. Because millennials, it's time to wake up. Smell the coffee. You're way, way, way behind where you should be at this stage in the game. So some pretty disturbing news for that age group. But there's something you can do. So hopefully you follow those 3 steps that we outlined. We'll be back here on the program Dollars and Cents. This is Joel Garris, Nelson Financial Planning, News Radio, WFLA, Orlando. Welcome back to the program, ladies and gentlemen. Dollars and Cents. This is Joel Garris of Nelson Financial Planning. If you missed the last segment, that's a pretty disturbing statistic, right? Millennials, 41% less net worth than their peers of 30 years ago on an inflation-adjusted basis. Not good at all. We gave 3 very specific suggestions as to what they can do to get caught up. Remember, millennials typically ages, 23 to 38 this year. So that 20s and 30s group, pay attention. Number one, go to cash. Use cash. That'll help you keep track of how much you're spending every week. Swiping, Venmoing, all that electronic stuff, it's easy to lose track of it. That's the reality. Go to cash. When there's no cash in the wallet, then you don't have anything to spend. Replenish that each and every week based upon how much you want to spend. Number two, don't be intimidated. Start. Any amount is fine to start. Just start. And number three, watch your investment allocation. The studies are out there way too conservative in terms of the investment allocation. If you're in your 20s or 30s, you should be predominantly for your retirement assets, the assets that you're not going to touch for 30, 40, 50 years. You should be almost exclusively on the stock side of things. You've got a long time to go, long period of time in which to weather whatever the market ups and downs are, but you've got to have that investment allocation. And during the break, Yaffe and I were talking. He wants to add a fourth one, so I'll give him props for that. Okay, don't work in radio as well is the advice that Michael Yaffe gives. Combined with the fact that it's really long hours, so it's just you don't want to. It's hard. Anyway, so be aware of that, and in particular, really try and get started for as little as you can. Just got to get started on it because those numbers are pretty disturbing for sure. Speaking of numbers, we thought we would talk a little bit in this last segment of the program to try and talk about what exactly earnings are and the different types of earnings that are out there. We just came out of earnings season. One of the things about earnings season that this past earnings season, it was actually a pretty strong earnings season, and so consequently, the market did well. Companies showed a lot of profit, and after all, that's another word for earnings is profit. So, as a business, if I have income coming in and then expenses going out, the income over the expenses then results in the profit. Hopefully, that's a positive number. If it's not, you're not a good business because you're losing money. So you really got to start to look at things much harder. But when you hear about big company earnings, okay, I think there's three different types of expressions that get tossed around, and we want to really help you as an investor determine exactly which one to really pay attention. Because generally there are three different types of earnings that you're going to hear out there. There's GAAP earnings, there's operating earnings, and then there is pro forma earnings. Okay, so we're going to break down what each one of those mean, and which one you as an investor really should be paying attention to. So GAAP earnings, GAAP basically stands for Generally Accepted Accounting Principles. GAAP, a GAAP report of a company on a profit and loss statement has got to follow the Financial Accounting Standards Board. It is your classic, pure as the driven snow, or as pure as the driven snow as it can be, definition of net income. Income minus expenses, that is your profit or your loss, and that is considered to be your GAAP earnings. So kind of your most formalized version of that income versus expenses. After that, the other versions of earnings is where you start to add or subtract things back in. So this is where the numbers start to kind of get a little funky. Operating earnings are a little bit funky, as in away from that truest reflection, that GAAP earnings, that truest reflection of what's going on in the business. Operating earnings is where you then start to add back in or subtract out things for unusual events. So maybe it's a restructuring or something like that. And those types of adjustments to those GAAP numbers that form your operating earnings, those have to be reviewed and approved by the Standard & Poor's rating agency. Of course, Standard & Poor's was the same one that put all the mortgage debt at AAA quality rated back in 2008. But hey, we digress. Anyway, Standard & Poor's is at the helm for making sure that there is a consistency on the reporting of earnings when it comes to reporting now operating earnings. Remember, operating earnings takes your GAAP number and kind of does some massaging on it. But all of that has to be done in line with Standard & Poor's rating agency. The third item is pro forma. And pro forma first came around, it's probably always been around, but I distinctly remember it being around in the mid to late 90s when, in my prior career, I was a practicing attorney. In my prior career as a practicing attorney, I was actually a corporate attorney that did a lot of mergers and acquisition work and also did a lot of IPOs, initial public offerings. Well, one of the fascinating things about IPOs, particularly, again, remember the time frame, mid to late 90s, is that pro forma was all the rage. Because pro forma is basically you take your GAAP, which then is adjusted through your operating earnings, and now with your pro forma, you basically take your operating earnings and then adjust them for all kinds of other things. That is purely based upon the subjectivity of the individual company itself. And you see where the problem comes into play. It's based upon the individual subjectivity of the earnings themselves. So things like goodwill or merger and acquisition or expected things to happen, there is a high level of subjectivity in pro forma. I saw it in that prior career, particularly bringing companies public. Some of the pro forma numbers were just assume everything basically happens and comes up roses and sunshine and rainbows and unicorns. And then you have your pro forma earnings. And many companies, particularly in the mid to late 90s, were using pro forma earnings to become publicly traded companies and ultimately to get investors to invest with them. Again, pro forma earnings, incredibly subjective. So if you as an investor are doing your own homework and doing your own research and trying to determine, okay, which of these earnings do I want to look at to really help guide me as to how this company is really doing, I think you probably have figured out by now you don't want to pay any attention to the pro forma because the pro forma is pretty subjective. GAAP is pure as the driven snow, but the reality is that the operating earnings, again, subject to the rules of Standard & Poor's rating agency, the operating earnings, what historically show has the biggest correlation to how the market and the company actually performs in the stock market. So we would urge you to forget pro forma and focus more on operating. If you want to look at the GAAP and see the difference between GAAP and operating, that's a good idea as well. But that gets into a level of complexity and a level of difficulty that's why you have professionals really making that decision as to whether it makes sense to invest in a company or not, because you can look at earnings, and if you're looking at the earnings, not the right earnings, then you can get a relatively cloudy picture of a particular company. So for our listeners, just know that there's a difference between the different types of earnings. Shockingly enough, there's different earnings, different labels. And when you hear earnings, think, okay, well, which one is this? If it's pro forma, watch out. If it's operating, okay, that gets a little bit better, and that's probably a good reflection, and history says that that's the best reflection of how that company is going to do. And then GAAP is sort of the purest version of it. So a little technical, almost a little collegiate discussion on earnings, but we thought it was interesting, particularly coming out of earnings season, and particularly to help draw the distinction between making sure that you know what you are looking at between the different types of earnings that are out there for a company. So certainly something to think about when it comes to that. We are about ready to wrap up and get on out of here, so we will do just that. Thank you all for listening to the program. This has been Dollars and Cents with your host, Joel Garris of Nelson Financial Planning on News Radio, WFLA Orlando.